Picture two investors. The first spends hours every week analyzing charts, timing the market, and executing complex trades. The second sets up an automatic monthly transfer, deletes the brokerage app, and ignores it completely. 10 years later, the active trader is exhausted and holding a portfolio that barely kept up with inflation. The investor who ignored their account entirely is sitting on a massive compounding surplus. If you want to master the hidden mechanics of money, like this video, subscribe to the channel, and turn on notifications. Most people never start investing because they assume wealth creation requires a massive initial deposit, insider knowledge, or a direct line to Wall Street. They look at a monthly surplus of 1,000 or 5,000 rupees and decide it is too small to make a difference. That hesitation is exactly how generational wealth is forfeited. The mechanism that prevents that hesitation is the Systematic Investment Plan, or SIP. It is a financial engine designed to completely separate human emotion from the act of investing. This chart shows a 5,000 rupee monthly contribution over 35 years. At a 12% return, it grows to 2.75 crore. This timeline reveals the 8-4-3 rule: 8 years of slow accumulation, 4 for a leap, and 3 for rapid growth. Albert Einstein called compound interest the eighth wonder of the world. He noted that those who understand it earn it, and those who don't pay it. The momentum builds because the returns generated on your principal begin generating their own returns. If left uninterrupted, it creates a self-sustaining cycle. The determining factor for financial independence is not the capital you deploy on day one. It is the total uninterrupted time that capital spends in the market. But this mathematical certainty collides with human psychology the moment the market drops. When portfolios bleed red, the instinct is to panic and sell. For a long-term SIP investor, a market crash is entirely different. Due to rupee cost averaging, a downturn functions as a heavily discounted sale on assets. This graphic illustrates exactly how that discount works. When the net asset value is at 100 rupees, your 5,000 rupee SIP buys 50 units. If a crash drops the price to 80 rupees, that exact same 5,000 rupees automatically acquires 62.5 units. You automatically accumulate much more assets at a significantly cheaper price. To protect themselves, people often hire fund managers rather than buying a basic index fund. This chart reveals the reality using SPIVA India data. Over 10 years, nearly 75% of actively managed large-cap funds fail to beat a basic benchmark like the Nifty 50. That underperformance is compounded by the invisible friction of fees. An active fund's 1.5% expense ratio will drain hundreds of thousands of rupees compared to an index fund charging just 0.15%. Over decades, the market penalizes expensive financial effort, while mathematically rewarding cheap, passive consistency. There is one flaw in the standard SIP approach. If you keep your monthly contribution at exactly 5,000 rupees for 30 years, you are ignoring that your salary and earning capacity will increase over that same period. The correction for this is the step-up SIP. As your income grows, you program your investments to increase by a marginal 5 or 10% every year. This chart demonstrates the impact of that slight adjustment. By applying a 10% annual increase to a base SIP of 5,000 rupees, you add over 20 lakh to your final corpus in just 15 years. When that corpus is eventually withdrawn, it will be subject to taxation. Under current rules, long-term capital gains above 1.25 lakh face a 12.5% tax, meaning the vast majority of your compounding remains intact. The step-up SIP automatically scales your investments alongside your career. It ensures your wealth creation keeps pace with lifestyle inflation, requiring zero ongoing willpower. The blueprint is highly accessible. Buy low-cost index funds, automate a step-up SIP, and then get out of your own way. The greatest threat to your financial security is not a sudden market crash. It is the cost of waiting for the perfect moment to begin. Give the market enough time, and the everyday currency in your wallet right now will compound into a fortune that outlasts you. Doing absolutely nothing while the market fluctuates is a difficult psychological discipline to master, but it is the one strategy mathematically guaranteed to work. Let us know in the comments what your starting SIP amount is, and don't forget to like and subscribe.